Welcome back. Sonata Software is one of the casualties of the day. The stock is down 14% post its Q4 earnings. The company's IT services, the international IT services revenues have fallen by 2.4% on a quarter-on-quarter basis. Margins too have seen a decline of more than 300 basis points sequentially, coming in at 21.1%, the lowest in the last many quarters. Samir Dhir, Managing Director and the CEO at Sonata Software, now joins in. Samir, morning. This is Reema here. First, if you could tell us what happened in Q4. Why are we seeing such a sharp drop-off in your revenues?
Yeah, Reema, hi, morning. Thanks for having me. So I think at the back of a very solid FY24, we did hit a bump along the way in last quarter. And I think there are predominantly two reasons. There was one large deal that we were pursuing, and it was pretty much all set to start in January timeframe. And based on the customer's internal organizational changes, the leadership changes, they pushed the decision out by several months. So that whole deal, we had the cost baked into the quarter, but the revenue didn't materialize because of their internal changes. So we really got impacted on both sides. One, the revenue didn't come through. And second, we had the cost because of the deal that was fully almost loaded for the whole quarter. So that's one of the main reasons that hit us. And the second reason that was in the quarter, which is an exceptional item, is we had a softness in quant, which is a seasonal impact. We talked about it in the last quarter's earnings release as well. That was anticipated. But the combination of these two factors, large deal push out and the quant seasonal factor, really hit us hard during the course of the quarter. But having said that, I think overall in the fiscal year, we made good progress. Y-on-Y, Sonata will still grow for the international business of about 34%. It's been one of the solid years for us, keeping Q4 softness aside, and tremendous work as a company. We closed 40 large contracts in the course of the year as well. So very proud in the whole for the year performance, but yes, we had a blip in the quarter, and we're confident that as we get into the next quarter, in the current quarter, which is April-June quarter, we'll bounce back to growth on a moderate to slightly up basis.
So you're saying in Q1, the company will revert back to growth, but it's going to be modest growth. Is that what the guidance is?
Yeah, it'll be moderate growth, and maybe.
So what is moderate growth? Like 1% kind of a quarter on quarter?
Between 1 to 3%, I think we should be able to clock in that zone, which is, in the current environment is still pretty good growth rate. But it will take us maybe 2 quarters to go back to our old growing ways that we were growing all along. This Q4 bump has really derailed us a little bit, but we're confident we'll fight back. And
so
like
Q1
I said,
and Q2 will see moderate growth of 1 to 3%. Right? And then you're hopeful things bounce back in second half.
That's right. That's why we are seeing the year going right.
And what about margins in the first half versus the second half? What is the guidance or the expectation?
I think the revenue and margin will follow pretty much the same trajectory. We'll follow in Q1 at least the same trajectory of margin increment as well. And in Q2, we'll catch up again. But Q2 is also the wage increase quarter for us. So we'll get a little bit moderated as a one-time activity because we'll do the salary revisions in Q2 for the company as well.
So is there a rough range that you can guide to, Mr. Dhir, for the year as a whole?
It's very difficult to we don't actually give full year guidance, but I think the trajectory we see for the next 2 quarters is between 1 to 3%. And then post that, as we make progress, we'll provide guidance for the whole year. But like I've been always talked about, that we are confident of beating the industry benchmarks. I think the industry has guided for about 5 to 6% year on year. We'll definitely be ahead of industry significantly even in this year, despite our soft H1 start. But we'll catch back up in the later part of the year.
Okay, we'll be significantly ahead of the industry growth of 5 to 6% in FY25. That's the guidance coming in for the full year. What about the large deals? I think you're pursuing 67 large deals, but how is the conversion taking place? How much longer is it compared to what we've seen, say, 2 years back?
Yeah, so I think the large deal is something which we have been quite excited about. Last year, we closed about 14 large deals, and I think we expect the same momentum to continue. But one has to keep in mind that given the macroeconomic situation that we are in right now, there's definitely a delay in closing some of these deals. What was taking about 3 to 6 months is now taking 6 to 9 months, in certain cases even 12 months. So the decisioning cycles have slowed down quite significantly at this point in time. But because we have created a large funnel, we believe we have created an engine to really replicate the performance that we had last year. we'll probably close in excess of 10 deals again during the course of this year as well. That's our expectation going into the year. So we don't see any softness there, but just the gestation period of closing out is longer than anticipated right now.
So expect to close approximately 10 large deals versus 14 in the prior year. And the deal closure cycle has gone up from 3 to 6 months to 6 to 9 months.
That's correct. That's correct.
Okay. Cash on the books is close to about 1,100 crore rupees, give or take. How are you planning to spend it in FY25?
I think we have always talked about we want to be a cash positive company. We have made a large acquisition last year, as you all know. We acquired Quant. At this point in time, Quant is fully integrated, and we're very happy with the performance and the progress that Quant teams have made. I think going into the later part of the year, we'll be open to doing some M&A activities as well, but that will depend upon us finding the right properties. Right now, we want to just make sure that we consolidate the acquisition that we've already made. But overall, very pleased with the performance of both the properties, Encore, which was acquired about 3 years back, and Quant, which was acquired last year.
So you're open to doing an M&A in the second half of the year, H2?
If it's right property presents, we've always talked about it. If the right property presents itself, we'll absolutely be open to doing it. But we'll not do it for the sake of an M&A. We'll do it for the right reasons based on the strategy we outlined. If you recall, we've talked about we want to grow in the US market, in the Europe market, and in the vertical that we have called out, in the technology area we've called out. If you find the right property, we'll absolutely not be hesitating to do that. But that's more like a later part of this year discussion. Right now, we just want to put our head down and get the next 1 or 2 quarters back on growth because we had a bump along the way. We want to get back to our 1 to 3% quarter-on-quarter growth back again.
So 1 to 3% is Q1, Q2. What about in the second half of the year when you're hopeful that things pick up and accelerate? Will the company go back to a 4 to 6% kind of a growth trajectory? What's the hope?
Candidly, it's very difficult to predict right now because the market is changing quite rapidly. It's something that we cannot provide any guidance for. But like we said, we were expecting H2 to be better than H1. That's our current expectation going into the year. But we'll have to watch how the first half plays out. We want to get the current demand pattern that we have, the current deals that we have, the current pipeline that we have closed out, and then go from there. That's the way we're thinking about it right now.
That large deal, which you were anticipating to start in January, and it got delayed, has it started? And is there a risk that more such large deals face, some deferral? Yeah,
sure. I think the decisioning cycles are delaying. Like I said earlier, the 3 to 6 months has become 6 to 9 months right now. But we have buffered ourselves with a larger number of pipeline in the large deals. So as we move forward, we can continue to hit the benchmark that we have put for ourselves to closing large deals. So that's our current thinking. On the deal in itself that got deferred out from Q4, it is not lost. It is still very much in the play. It's hard to predict when will that deal materialize for us because the customer is going through some internal organization changes. As they stabilize their organization and the new leadership settles in, they evaluate their priorities. We'll probably know in about a couple of months as to what the decisioning time for that deal is.
Okay. But since the deal has not started already and Q1 has begun, a month and a half is almost through, of this particular quarter, will it impact margins or will Q1 margins be better than Q4?
Q1 margins will definitely recover in the same zone that we had guided the revenue to be. We'll think it'll recover from that basis. But the deal in itself probably is more like a Q2 deal, depending on when it closes out.
Thank you very much, Mr. Dhir, for providing clarity on what went wrong in Q4 and what the outlook is for FY25. So that's Sonata Software, confident about significantly outpacing the industry growth in FY25, margins to recover. They're hoping things pick up in the second half of the year, but Q1 and Q2 should see moderate growth. Get into a break. On the other side, we'll put the spotlight on a whole host of stocks. Stay tuned.